I think it's a new experiment. Like, Morpho V2 is unlike anything that has been done in DeFi. We like to take bets, and I think that's a huge one. Is to could have like tremendous upside that goes way beyond like the current state of lending today if it succeeds.
Quick shout out to today's sponsor, Katana. We'll hear more about Katana and their pre-deposit campaign later today. But for now, let's get into the episode. Quick shout out to Permissionless IV coming this summer to New York, June 24th through June 26th. We'll have speakers from all across the industry, including Hayden Adams, Kyle Samani, Guy Young, and more. Get your tickets today by following the link in today's show notes, and make sure to use code BELL10 to save 10% on your purchase. See you there. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another episode of Bell Curve. Thank you for bearing with us here. We had a little hiatus from our last episode here, but joined back with my trusty co-host Monet, and today we're talking to Paul Frambot of Morpho. Guys, welcome.
Thanks for having me.
This one is going to be a really fun one. Paul, I didn't mention this to you or Monet actually before we recorded, but Bell Curve is about a 2-year-old podcast, and actually the very first season that we did was on the need for fixed rate borrow lend in DeFi. So this is a podcast actually 2 years in the making. I'm happy to see that Morpho is taking the lead here. And really want to spend a bunch of time talking about Morpho V2. So actually we were discussing here before we got on that. So the fixed rate borrow lend is kind of the headline of Morpho V2, but that actually wasn't the intent when you guys set about designing that, right? It was actually more about solving some of the issues or improving and iterating on Morpho V1. So can you we've done a couple of podcasts in the past, so we'll link them in the show notes, but can you just give us a quick overview again of Morpho V1, what the major components are, and how did that lead to V2?
Sure. So, Morpho is an on-chain lending and borrowing infrastructure that lets, anyone create their own lending and borrowing use cases on one end to earn yields with a specific risk profile or compliance profile, and on the other hand to get financing with collateralized loans, right? And think of Morpho just as like a permissionless, immutable, like flexible infrastructure where people can deploy and do what they want with this. And so the V1 of Morpho was focused on like a variable rate primitive where essentially you could only create lending and borrowing markets that have like a rate that is controlled by an algorithm, saying that what we have in the field, we call this an interest rate model, where essentially the interest rate is dictated by an on-chain formula that can either be governed or is just an immutable formula that controls the rate. And what V2 brings to the table is essentially removing that formula, removing the need for the rate to be controlled. And this time, the rate is decided by the market. So you have an active set of participants that can price the risk of the loans and essentially say, hey, I'll borrow this at 4%, or I'll lend that at 2%. And, we have this amazing network of curators in Morpho that are essentially like very complex DeFi players that have a lot of capital and can allocate it in complex ways. And until then, they were just managing the risk. Now they will be both managing the risk and the rate.
Excellent. Okay, so before we get into the unique design here, I would love to get a sense. So fixed rate borrow lend is actually something that has been iterated on or tried in crypto at least before. There are solutions that exist. I think what we did season 1, we talked to Teddy from Notional. Term is another attempt at this, but we haven't really been able to achieve like anything over like $1 billion in TVL or really take off. And I remember a couple of years ago reading about people look at the, total addressable market of debt in the US, and they look at the amount that's fixed and variable and say, hey, look at how much more there's fixed rate lending here. And there's an obvious need for this, but it never really took off in DeFi. And I'm curious, what was missing? Was it infrastructure needs? Did people not get the model right? Was it something about the market? Why haven't we seen it fully take off?
Right. So I think a few things. On the need side of things, fixed rate is definitely needed. I think especially if we want to, grow DeFi beyond like crypto users. It's not crucial for DeFi native users and funds that are quite active, that, value a lot flexibility and ability to withdraw and exit. So liquidity is actually more important than predictability of the rate for very crypto, DGen, DeFi users, etc. And even in crypto, like in exchanges, you have a lot of like perpetual, exchanges, which also don't have like those kind of like predictability. But that's very crypto, right? In traditional finance, fixed rate is insanely important for two kind of users, really institutions and large scale consumer, right? For example, as you know, we probably know we're integrated in the Coinbase app and for Coinbase loans. And the typology of users that are using Morpho through the Coinbase app is very, very, very different than the one that's interacting through the app morpho.org. And those users are, just retail users looking to take a loan to buy a house, right, or to spend it on their credit card. And those kind of use cases are much, better done with fixed rate. And it's actually the number one feedback that we've gotten from this integration from those users is that we need to have like better predictability as like retail consumers. And now you have institutional finance where fixed income is a huge deal for a lot of different reasons. And those are the guys like looking at DeFi right now and saying, hey, we'd love to get involved. Like we now have the regulatory environment to do so, but just variable rate is a blocker for us. So those are like the two major needs and why I think time to market for fixed rates is unique right now, because those two entities are coming on chain and they see this as a missing piece, right? Now there is the question of why haven't we succeeded in doing this before as an ecosystem? I think there are mainly two reasons for this. There's a technological reasons and a ecosystem maturity / player complexity reason. On the technological side of things, we've built fixed rates so far as an ecosystem on top of variable pools, right? So most of the fixed rate protocols that we've seen in DeFi are built on top of Morpho, or built on top of Aave. And essentially what they do is they use Aave and Morpho as some kind of like rate oracle. And they oftentimes like try to strip the yield part from like the principal part of the assets. And then the yield is traded on an exchange. And those are most often yield betting platforms, right? As opposed to like actual native fixed rate protocols, right? I think Morpho V2 approach is actually the opposite. We're building a variable rate, liquid variable rate, like lending protocol that you could have, like today, when you deposit into Morpho, except that behind the scenes, there is like a fixed rate primitive that is being used, right? And this leads to the second reason why fixed rate hasn't been so successful in DeFi so far is that managing a portfolio of bonds is non-trivial, especially when you have a lot of different use cases. Like those are like liquidity and rate is like, dimensions that are not easy for consumers to always manage. And the good news with Morpho is that the way it's structured, we have this gigantic ecosystem of players. We have approximately 25 different curators that have like billions of dollars deposited in their vault that are competent entities to do this kind of role and abstract this away for the end user, right? And so they can quote on fixed rate, they can market make on fixed rate, etc., which is not something we had a few even months ago for other fixed rate protocols.
So I am hearing that like basically the curators will kind of solve that UX challenge that's been hamstringing fixed rates from the perspective of lenders. But I also kind of see that it might be a bit of work, especially for like retail users who are wanting to borrow at a predictable rate once they come up to the end of that loan term, however long it is. Like, what do they do next? Do you have an idea of how the borrower side of the equation will be kind of like managing that UX and handling that?
Sure. I think the best way to understand this is to go through like an example of how a Morpho V2 vault would look like in practice and how borrowers would be borrowing from that. In a V2 vault, essentially you have, let's say, like the block Analytica vault of USDC. Let's say you have 100 million that is deposited into it. Well, block Analytica could do one thing, could deposit like everything into Morpho V1 and have like a 90% utilization curve that guarantees that 10% of the liquidity can, statistically be always redeemable by its users. But progressively, what it can do as well, it can start offering loans to fixed rate borrowers, right? And it could say, hey, if you're willing to borrow for X months or X days with those assets as collateral, we're happy to finance your loan with the liquidity in our vault. Obviously, Block Analytica would have to make sure not everything is locked in like a 2-year like maturity loan, but they can essentially build a portfolio and say, hey, maybe out of 100% of the vault, maybe 10% is idle, and maybe 20% is like very short-term duration, like a few days loans, and maybe 50% of the vault is like 30 days loans, etc., etc. And so the way it looks in practice is that the vault curators will place those gigantic fixed rate bids and say, hey, we're happy to lend at rate X during duration Y. And the way Morpho V2 is structured is not a pull model, but an offer model where you can express this intent across a very wide variety of terms and of risk and of compliance with the same liquidity. So the same 100 million that is in the vault can be offered at hundreds and hundreds of risk profiles and compliance profiles at the same time. And so now you take the consumer bar side of things, where you have a myriad of opportunities because the curators have priced every single like collateral and they gave a price to each oracle, etc., etc. And so you can come to the interface with your Bitcoin or with your uni as collateral, whatever, and you can see what are the offers that are made by curators. And those offers are already more digestible than anything. So you can tap into those orders and essentially do a take order that would buy some of those. That would sell some of those bonds essentially. Then we can talk about rolling and everything, but at the high level, this is what a fixed rate loan would look like in Morpho V2.
This episode is sponsored by Katana. If your assets are sitting idly, they're dead. Katana is built from the ground up to bring your bags back to life. Be early to Katana by joining the pre-deposit campaign before mainnet opens at the end of this month. Follow the link in today's show notes to get started. Today's episode is brought to you by Ledger, the global leader in digital asset security. Celebrating 10 years of innovation, Ledger is trusted by 7 million users, secures 20% of the world's digital assets, and remains the most secure hardware wallet for your crypto and logins. Follow the link in this episode's show notes to grab your Ledger today. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
I want to get into the actual architecture here of Morpho V2, but maybe one last question here on the analog and TradFi. I know that Morpho V2 utilizes an intent-based model that kind of is an RFQ-like system, and I've got Hart Lamber's voice bouncing around in my head actually describing, he used to be a bond trader, and he's described that this is actually the market structure for how treasuries essentially trade as well. And I'm curious, I want to understand a little bit more actually what you said about at the core of it being a fixed rate primitive versus something that's variable, because my understanding is that even in traditional finance where you get a lot of fixed rate debt, still things are at their heart variable, but you have these other markets like interest rate swaps, which allow you to lock in longer fixed rate securities. Like a 30-year fixed rate mortgage, if you talk to anyone who doesn't live in America, that's not an animal that exists in the wild. That it's basically, that's SOFR plus, the bank goes out to the interest rate swap market and locks in this very long-term thing. And that's actually because you have a bunch of basically degens that want to take levered bets on interest rates, right? That's why you can make, that's the financial alchemy that goes into that product. And I'm curious, so help me understand how that translates here. Why it's technically variable and then it gets, morphed into something that is fixed rate. Yeah.
Yeah. So at the core, what the Morpho V2 is a zero coupon bond like issuance and settlement protocol, right? Mm-hmm. So you say, hey, I would like to borrow against those terms. I mint some of those bonds and I try to sell them to people, right? And the price you sell them at is the discount you essentially price it at before the end of the term. And at the end of the term, you can redeem it 1-1 for the assets. And so this primitive, if you look at the loan agreement, it's a fixed rate term. However, to the eyes of a vault depositor, if you deposit into Block Analytica USDC, well, Block Analytica will have hundreds of bonds maybe, right? They'll buy bonds that are short term, some that are long term, etc., etc. And to the eyes of the users, this gets aggregated. The liquidity gets aggregated. So there is also statistical liquidity that could mimic the one of the interest rate model. Maybe 10% of the vault is always liquid, maybe more, maybe less, depending on the guarantees that are offered by the vault. So you get the liquidity. And but the rate is variable, right? Because maybe some bonds will expire today and some others in a few days, etc. And so this is what I mean by variable rates built on top of a fixed rate primitive, right? And you mentioned treasuries, but the hope is that one day, and I think it's this day, not too far, but U.S. treasuries, for example, and the Bank of New York will actually mint those on chain directly on Ethereum, right? And so if you have a vault and you have those Morpho V2 bonds, which are for over collateralized crypto over collateralized bonds at the moment, you could also aggregate those with treasury bonds, right? And so maybe you have a 6 months US treasury or a northern European country, I don't know, whatever. So, and you aggregate those into a vault, which again, to the eyes of the user, will appear as a money market fund, right? Which is variable rate liquid. Does that make sense?
It does. It does. Okay, maybe that's a good transition point here into Morpho V2. And maybe if we could, break the architecture down into there's a markets level to it, and then there's a vault level. So we've got a V2 on the markets and a V2 on the vault. Whichever order you want to tackle those in, describe, I guess, some of the high level benefits of Morpho V2. And then if we could align those to, where does that belong in the markets and vault improvements?
Sure. So let's talk about V1 first. So the way Morpho V1 is organized is you have vaults for depositors that are curated by a curator. So you deposit your USDC in a vault, and then the curator of the vault is going to allocate it to immutable lending markets, right? And those markets in Morpho V1 are variable rate lending, whose rate is dictated by an interest rate model, a formula essentially. And those are crypto-backed loans, and a market could be CBBTC to borrow USDC or STETH to borrow USDC. Those would be two lending markets. Lending markets. And then the curator would plug on top and aggregate those and distribute liquidity to each of those. Morpho V2 is a very similar structure where Vol V2 works exactly like Vol V1. The main difference, there are a couple differences, but the main difference is that those vaults are now able to allocate to Morpho V1, Morpho V2 markets, and maybe, if in the future V2 markets have improvements, or if there is a V3, I don't know, then will be also able to allocate into those, right? There are a couple of nice features on Vol V2 that we're introducing, on rules and caps, but whatever, it's not so important. So Vol V2, same as Vol V1, except now, those are general aggregators. They can aggregate market V1, market V2, and potentially V3. Now, what are market V2? Well, market V2 is essentially, at the high level, you could think of it as a lending order book, right? I don't think that's the right way to think about it a bit more precisely. It's essentially a protocol that allows you to trade zero coupon bonds for over collateralized lending, right? And so in practice, this is intent-based as opposed to pool-based. What do we mean by this? In Morpho V1, you have to allocate liquidity in the pool and wait for borrowers. And that's the case for all DeFi, frankly, except for a few intent-based protocols like Uniswap and others on the taking side of things. But until today, it was you deposit your liquidity in a pool that allows specific borrowers to come in. Do they have the Bitcoin collateral with the right threshold? In Morpho V2, you promise your liquidity and you make an offer off-chain that you sign, and you say, hey, I have 1 million in my vault, and I'd be fine lending it to this opportunity, to this collateral, but also maybe to this collateral. And you can make a very long list, right? So the unicity of Morpho V2's design is that liquidity can be promised at multiple risk profiles at the same time, at multiple chains at the same time, at multiple compliances at the same time. I'll give you an example. You have liquidity on Ethereum. You could say, hey, I'm happy to settle on Base, but also I'm happy to settle on Arbitrum, right? Here's my liquidity. Whenever you take my offer, we'll bridge the liquidity just in time with the bridge that I specified, and you'll be able to take a loan there. you have the same parallel with compliance and the same parallel with risk. So anyway, and so the way Morpho V2 like markets are structured is a bonds trading protocol that is intent based as opposed to pool based.
Awesome. All right, I've got a lot of follow-up questions here. Why? So there's a couple of different designs you could have looked at, I guess. There's like the intent sort of RFQ-based system. There literally are approaches, in my understanding, like a limit order book built on maybe like a Uni V4 hook or something like that. And then there's also auctions-based. So can you kind of walk through what are the trade-offs of each of these approaches?
Right. I think for us, the most important challenge you have in lending, especially if you are going the path of Morpho, which is a free market driven approach, is fragmentation, right? Like in Morpho V1, we have a lot of different markets, right? And the managers allocate to a specific market. But then the problem they have is like, okay, what if the borrowers is going to come from another market, right? And so we have this concept called the public allocator that allows you to promise liquidity on multiple markets at the same time. But the problem is that the rate is variable, right? So if you move liquidity around, it could spike the rates, et cetera, et cetera. And that's has been just a fundamental limit of variable lending protocols. And so we thought about fixed rate. And then the big question was like, hey, what is the system that allows us to promise liquidity at multiple places at the same time? And this, you have multiple ways we could have approached this, like, RFQ auctions, etc. But really, the very simple thing on top of which you could build more complex pricing systems is just you have liquidity, you make an offer, and you say, I'm happy to. So it's literally like a message that you sign and that you'd broadcast in a mempool. And in this message, you say, hey, I have $1 million. I'm happy to lend it against like BTC, right? And whoever is the borrower that sees that can take it. And so there is no such thing, such market structure that is like, similar or has a name to this already. It's just like a simple data availability layer of some sort where you just like broadcast your intent about what you're ready to lend and borrow and at what price. And when you take all those offers together, they're just a gigantic order book, right? That has many dimensions being like the oracles, like the collateral, etc., etc. And so essentially what you're placing here is limit orders. So those are orders with limit prices, like limit rates, that are on multiple dimensions of the order book. So your offer commits liquidity. Just think of it this way. You have one order book for each lending market, say like Bitcoin to borrow USDC, ETH to borrow USDC. Your offer is a limit order on multiple order books at the same time, right? And this is like a concept that does not exist like currently. Like I do believe we're like sort of like the first to approach lending through this lens. And so yeah, I wouldn't have like a comparable or a name for it. Maybe you should come up with one, by the way.
Yeah, it's super interesting. I think it does feel like a bit new that you can kind of lend against or like make offers against all these different markets at once. And it in a way it sort of addresses a challenge for curation in Morpho V1 where you're all sort of forced into coalescing around a few different types of markets. Like if you look at V1 markets, all the curators tend to be working with a single like LTV option for the pools because it's just a lot more efficient for everyone to be kind of making, liquidity in the same markets. But then when you look at, other sort of RFQ based markets in TradFi, something like the US Treasury market, there's like a divergence between on the run treasuries and off the run treasuries, where like basically the most liquid sort of newer issued ones tend to have most of the trading interest and they have a lot better liquidity. So I'm wondering do you anticipate that there might still be like similar pressures for V2 where like maybe the maturity dates that people trade in will get standardized or the sort of loans that people are making will get standardized just because it's better to be having all of our trading interest in a fewer number of products?
It's a very good question. I think that's the curse of modularity, in general, is fragmentation. And so you have to come up with ways to limit modularity and coordinate the ecosystem around few things that make sense, right? For example. And so one example of this
North
would
Star,
be,
maybe?
yeah. And one example of that would be like duration versus maturities, right? Like when you say like a 30-day loan, it's very unlikely that people will coordinate. Like if you make an offer for a 30-day loan and someone takes that offer, today at like 3:36 p.m., it's very unlikely that someone is going to have the exact same like duration, in mind, right? And so this is a typical example of like if you offer the full freedom on duration, then it's very tough to aggregate markets. And this is why we prefer terms as opposed to durations, where, in Morpho V2, you don't specify how many days you want to trade for, but you specify an end date, right? So for example, end of week or end of month or end of day, etc., which are like the kind of tricks that help coordinate the market. The mempool as well, like, the way it's done is that at the protocol level, we don't impose like we want to have the flexibility for people to actually be able to trade with the terms that they want, but maybe at the mempool level we'll have restrictions where it's really not useful for the world to have like 1 basis point difference in your LLTV, right, and creating and fragmenting the market, etc., right? And so there are a couple of things you can do, and I think the theory is that the market should aggregate over time around like the most relevant bonds. Truth is, sometimes you always need to push the market in like certain direction and help it aggregate faster. So yeah, it's one of the big area of thinking that we have right now, is like, at what level do we constrain modularity? Should it be at the protocol level? Should it just be at the app level, right? And just say, hey, you can't create a new market with like a crazy stupid like LLTV at the 10 decimals, for example.
Yeah, so you mentioned tick size, and that kind of got me thinking a little bit. There's other sort of like ways that order book or RFQ systems and TradFi sort of design themselves to like avoid uh, abusive behavior that ends up making liquidity worse and kind of like just spoils the market for everyone. So like one thing is generally when there's tick sizes, so you can't just do like a millionth of a percent better offer than someone else. And then when you make an offer, you're kind of like at the back of the book for that tick. So whoever made the offer first gets filled first.
Right.
And it's an incentive for people to put liquidity and keep it there instead of just trying to like join that tick right at the end and sort of like siphon off orders from someone else who is actually providing liquidity more actively. Do you have like an idea of like
Right.
how
So
that sort of
I
like order book management works?
no, 100%. Like, fat tick size plus FIFO, like as you described, to me is a very good incentive not to have like just dark pools and people that constrain their liquidity and just in time will provide it whenever they see the opportunity. I think it's one of the big areas of topics as well for trading research in general on chain is just pre-trade transparency. Like, it's unclear if the optimal situation, for example, in the case of Uniswap, is like everybody has their closed orders on Uniswap X and they don't disclose it, right? And nobody's in the pools. If we look at like the max efficiency, like everybody's like super optimizing, etc., which frankly can be a problem and end up in worse outcomes for everybody that is trading. And so our philosophy around this has been like, it's our role to progressively unleash modularity as opposed to like come in with like 10 decimal precision like tick rate flexibility, but rather it's, if there is one role that governance can play, this is the one, right? It's just like progressively unleash like modularity in the ecosystem, so that it is thoughtfully used as opposed to like everybody does its own thing and the market does not coordinate, etc.
Shout out to today's sponsor, Katana. Katana is a DeFi-first chain built for deep liquidity and high yield. No empty emissions, just real yield and sequencer fees routed back to DeFi users. Incubated by Polygon Labs and GSR, Katana is launching with notable ecosystem of primitives, assets, and partners like Morpho, Chainlink, and more. Be early to Katana by joining the pre-deposit campaign before mainnet opens at the end of this month. Follow the link in today's show notes to get started. Ledger is the global leader in digital asset security, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a comprehensive ecosystem of products and services, making digital ownership more secure and accessible for everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, introduced the world's first secure touchscreens, making it easier and safer to manage your assets. Alongside Ledger Stacks and Ledger Flex, they have also launched the Ledger Security Key app, offering a safer alternative to traditional password management. Follow the link in today's show notes to get started with Ledger today. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
So you know what that made me think of a little bit, Paul? I'm curious. I had this question for you later, but maybe we can address it now. I'm curious what the MEV implications are of this design, especially when it comes to things like cross-chain settlement. Like, you know, what Monet was just getting at there, your place where you are in the order book. This is a really interesting issue for, you know, protocols like Uniswap, where you have JIT liquidity, so just in time. And you can either view that as you're stealing fees from LPs, or, and people, MEV researchers have flip-flopped on this, you're actually providing better execution for traders. And so, you know, I'm curious, you know, how you would think about the trade-off there. Obviously, from the curator standpoint, you know, you want some sort of preferential place, but obviously users just care about best execution and probably getting the lowest spread there. So I'm curious how you think about that. And then maybe we can get into, I'm curious, whenever I see something like you can open a loan on Base but get liquidated on Ethereum, I'm like, ooh, how does that MEV, what are the MEV
Right.
implications?
Yeah, we should chat about this because, okay, so maybe on the MEV part, there are few MEV implications, much fewer than on like a Uniswap, for example. I think overall, because when you trade, it's like instant profits that you can, you know, automatically steal from someone. In lending, there is this idea that you enter a more of a longer term contract and you can actually lose money in the deal. It's not as easy as like copy trading other people and, you know, being faster, because you could like decently lose a lot of money doing so. And those are like, you know, if you enter a bond, you can, you know, not immediately resell it, for example, etc. And so you better be very careful about like how you copy trade and in general. So the MEV implications are much lighter in lending like order books, where there is no high frequency really. Like the way we think of, I mean, initially there won't be too high frequency. Initially, the way we think about it is just like curators will have a ton of liquidity and they will place huge bids like on many different, you know, markets, and then borrowers can come in and tap into that liquidity. It's as simple as this, right? Obviously, over time, players will complexify. They will start to like, you know, make smaller orders at better rates, and you will see progressively like a gigantic order book forming. But I don't think we need the full like, you know, high frequency order book for lending, just because of like the frequency of the needs and of the trades is just very different than in trading. For the cross-chain component, to be clear, this is not something like you have your collateral on one chain and you take a loan on the other. Every Morpho V2 is permissionless and immutable, like entirely, and it does not enshrine any bridges, nothing of this. So it's very similar code than Morpho Blue actually, except it does not have the interest rate model part. The key thing is that when you make an offer and you say, hey, I'm willing to, you know, lend USDC at terms ABC, you have to specify a callback, right? And this callback is a piece of code that will be executed by the borrower to source the funds, right? So what does that mean? It means that, you know, when you are promising this liquidity, the borrower sees, oh, someone is offering like Bitcoin, is offering me to borrow with my Bitcoin their USDC. And maybe their USDC is productive somewhere. Maybe it's on Morpho V1, right? And so when I take this trade, I'm going to execute the callback. It's going to withdraw from Morpho V1 and transfer me the money, right? Which, if you're familiar with Morpho Optimizer, is the exact behavior of Morpho Optimizer, but that's another story. I won't get into that right now. But essentially, you execute a callback that's going to source the funds, but the funds can be in an arbitrary place, right? It could be in your wallet, idle, waiting for a match. It could be on a lending pool, waiting for a match, or it could be on another chain, in which case the callback is a bridge. And I'll simplify a little bit here, but essentially the taker executes the bridge code, which is going to source the funds and bring them just in time, right? And the callback specifies the bridge, not the protocol. So we as a protocol, the protocol as a protocol does not enshrine any bridge. There is no governance deciding or changing the bridges all the time, which is probably something you would see in other like monolithic lending design approaches. In the Morpho approach, bridge is just another component of risk, and people have to assess it. And when they take it, like there is an execution risk that is just in time, but there is no like long-term risk of the protocol. And so when the funds are sourced, then the settlement happens on one chain, and the collateral and the loan assets are on this chain at the moment where the trade happens. There is no such thing as like splitting the collateral on one chain to borrow on the other. Does that make sense? It's actually the first time I explain it, so maybe
it does. No, it does. Okay, I'm just gonna keep pressing ahead here. I've got a million more questions. So you described the difference in user profile on Coinbase versus Morpho V1 instance, and I would be curious. Do you have any sort of I know Morpho V2 isn't live yet, but do you have any expectation around what the term preferences you expect to look like? I think I'm remembering back to this original DeFi season that we did, and people were talking about 30-year fixed rate mortgages on chain, and I'm kind of wondering if maybe the demand around V2 is really around looping, and so the funding requirements here are closer to 30 days or maybe 90 days max. And there's obviously a on the demand side preference of what are these, what's actually getting funded here. But then there's also, I think one of the challenges historically around fixed rate borrow lend has been on the lending side as well, and how long people are willing to lock capital up for, especially if a loan goes bad and you can see your capital drop very quickly. So yeah, I'm curious, like I'm kind of asking you to speculate here, but where do you see this market shaking out in terms of preferences?
No, I think it's really depending on like how crypto natives, like DeFi natives / complex you are. Like, if you interview users in the DeFi space, I think the max I've heard is probably 90 days. It's always lower, almost like 1 month, few days, 1 day, even a few hours for some people. And so I would expect like the DeFi, DeFi funds and DeFi users right now to be more in the range of like from 1 day to like 30 days, 60 days is my expectations. 3 months being the max. And what's interesting is that it's very different from the consumers of like large scale consumers, where here you could have like different kinds of loans. If it's like a loan for like a big project in your life, obviously it's going to be much longer, for like a mortgage or like whatever. You also have like, this is more like credit related, but like all the buy now pay laters that are also like shorter terms. But yeah, so I think unfortunately there is going to be a split between like the people that want like the shorter terms that are like more crypto native or more complex users, and like the large consumers application that will require longer terms. But that brings back to like the term versus duration question. The good news is that if you have a 2-year loan that's like end of year, maybe or 1 year loan that is end of year, well, it becomes a 6 months duration bond, in June, and 1 month, in December, it's like a 1 month bond. And in Morpho, primary markets and secondary markets are merged together, meaning that if you want to enter a loan that is 1 month, you could simply enter a 1-year loan that started 11 months ago, a 1-year bond that started 11 months ago. Whatever, that's a technical detail, but there is a big question of like, how do you have liquidity work together between two worlds that at first glance look separated in terms of like, financing needs.
So hearing you talk, I kind of brought up a follow-up for me a little bit. So um, one thing that you see in certain types of consumer loans in traditional finance, like for mortgages, actually, it's really common, is they have these 30-year loans or long-term loans. They're at some fixed rate that they lock in based on whatever the then current interest rate markets are looking like. Um, But if the interest rate markets then go up in the future, the user's very happy. They have a low rate loan. They're paying less than they could have. If the market rates go down, however, then they suddenly have this incentive where, if I refinance my house or if I do some other sort of action, I can get out of this loan, which is no longer a good deal, and get into a better loan. And I'm wondering, do you see like potentially like a similar like risk or like a dynamic that might happen for longer term Morpho loans? Like if you're a borrower and you're paying some very high rate, maybe you let yourself get liquidated, or maybe you take some
Right.
other sort of action to try and welch on the loan. Is that something that you anticipate, or maybe you don't think it'll be a major factor?
It's a good question. We don't so first I should say that we thought Morpho V2 as a short-term fixed rate protocol initially. So we haven't, spec'd things out for like 30-year bonds and those kind of use cases. And our high-level analysis that would work well with such bonds. But the vision here is really to replace the interest rate model, and you do this with short-term bonds that are aggregated together with people that are professional and can trade with those. Less so with like very long-term mortgages that are more like peer-to-peer fashion like deals that is very bespoke to the individual that is talking to with like whatever banker, etc., etc. In Morpho V2, you can refinance and you can move from one loan to the other. It's possible. It's ideal if you have some like secondary liquidity for the given loan that you are looking to repay, and you have we'll see how the market reacts, but maybe there'll be also arbitrageurs like allowing you to exit early at a discount or those kind of things. But I have to say, like, we haven't optimized the use case for multiple year bonds. I will say though that Morpho V2, the way it's structured, can work with multiple kinds of bonds. We're starting with over collateralized crypto bonds, but in the future it could welcome other kind of bonds, right? So if we find that there is a very cool use case around like 20 year mortgages specifically, we could reuse the exact same market infrastructure, just change like the bonds protocol. And Morpho Vaults V2 are general, so they could be able to allocate liquidity to those bonds as well, if that makes sense.
I want to talk about what this means for curators specifically here as well. But actually, just to build on Monet's point, so even if it's not you're refining a 20-year mortgage, I could imagine, let's say I'm running some sort of looping strategy and I lock in my 30-day rate, but rates go down and it's like, oh, I want to refi this rate. Is there the ability to do that even in the shorter term?
Right. So assuming there is no secondary liquidity at all, you have to repay full the amount that you were supposed to pay with interest in order to be able to get the full extent of your collateral back.
Right.
In practice, though, it's very likely that someone is going to be happy to take a better rate out of this. So if you're very alone and there is no active liquidity, you won't be able to live like at a better rate, right?
Yeah.
However, if the rate truly went down, you're probably going to have people taking the arbitrage on the other end, right? And if I am an active curator and I see this happening, and I see this as an opportunity to beat the market in terms of rates, I will offer you secondary liquidity, right? Because you'll be, happy, instead of paying like 10%, maybe you'll be happy to pay 9, whatever. I'll take that 9 if the market rates are at 5, right, or something like this. And this is the whole benefit of having an active set of curators that are, essentially looking to maximize their profits. Is they're gonna take those arbitrages and they're gonna offer the secondary liquidity where it's needed. And to me, that's the crucial missing piece that you don't have in fixed rate protocols of the early days, specifically. Or you would have to build everything in protocol, so it would be like very heavy in governance and complexity, etc., which is obviously not the way we like to build things at Morpho.
So it's on you then, Monet, to offer that secondary liquidity. Yeah. But
whenever there is a problem, it's like for curators.
This episode is sponsored by Citrea. Citrea is the first zero-knowledge rollup to enhance the capabilities of Bitcoin blockspace, enabling Bitcoin applications and unlocking Bitcoin's full potential as a programmable financial platform. With Citrea, developers can now tap into Bitcoin's liquidity to build scalable payment systems, privacy solutions, and more. Citrea is currently in its testnet phase and is approaching its mainnet launch. To learn more about Citrea, follow the link in today's show notes. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Actually, kind of a question though to both of you. I mean, I'm very curious, and Monet, maybe if you could switch hats here between Bell Curve co-host and BA Labs curator. I'm very curious what this does to the curator market here and what this opens up in terms of design space. It sort of seems like this is another lever to play with and a way to differentiate. And I'm just curious, maybe Monet, from the side of what this opens up to you guys in terms of strategies, but also just how you see the market changing here. Like generally when you make things more complex, you end up concentrating. So I'm just curious about, maybe in the weeds of what this actually means for curators, but then how you see the market evolving.
Yeah, I guess so. One thing that I've seen for curators on Morpho V1 is that a lot of the vaults look fairly similar to each other, and there will be like sort of different risk tiers. So curators like sometimes we'll have multiple tiers of USDC where we'll have like sort of a higher risk and a lower risk version. It's pretty common with like Stakehouse, Gauntlet, a lot of the other big curators will have different tiers, but across those, the low risk vault, everyone's low risk vault looks fairly similar. There's like sort of a same relatively small, set of pools that we're all lending into. The exact split of assets between each one is going to be a bit different, but it's the products are quite similar, and we're kind of competing purely on brands and sort of distribution and different factors like that. But I think once V2 comes around, it's really going to like just completely explode out the design space where you're not only going to have different types of collateral like tail risks that you're lending against, but it'll be a lot easier to have higher or lower leverage that you'll be able to lend against. You can start serving different durations, so maybe most of it is going to be a month or less, but some vault curators will be able to say we're willing to take on a different maybe up to 3 months or 6 months, and that'll really change kind of the return profile, but also the risk profile of the vaults. So I think the actual vault itself, all these vaults that curators like us are offering, is going to be much more differentiated, or at least will have the capacity to be much more differentiated. So I think that'll be really interesting. Now, on the user side, I think it also creates some interesting challenges where now there's like so much more information to take in about what vaults you're putting your funds into. So I think analytics, like we also at BA we work on a lot of analytics products to help people understand lending products. There's going to be so much more to do there too, to like help users surface what are these different options, what's the trade-off with going with BA versus Steakhouses versus Gauntlet, or whoever else is curating here.
Yeah, I would definitely second this. Like, I think when we launched Morpho V1, one of the biggest concern we had was like, is anyone going to be wanting to be a curator? Like at the time, the term did not even exist, right? Like we sort of coined this like a year and a half ago, and so I was like, it has to be simple, right? Because I mean, quote unquote simple. It has to like, we shouldn't allow for too many dimensions of freedom, because otherwise, like, no one is going to do it. It's like and so a year and a half in, I'm very pleasantly surprised that everybody wants to become a curator and compete in this. But that also means that we probably have been a bit slightly too conservative in terms of like the dimensions of freedom that we allow. And now I think is the perfect timing to actually enable a whole new area for curators, especially now that we've proven that the curator model works and that it can make actually very good businesses. And so now people are sort of like have the trust and the incentive to actually put in the resources necessary to make fixed rate happen.
So actually, that's kind of brings up an interesting point, Paul, which is in general, in all of these markets, be it cow swap on the solver side or across on the their RFQ sort of solved it. There are lots of markets now which have adapted this intent-based model, which I really like. But it has been a constant surprise to me that you haven't seen more actors pop up to be solvers, builders, curators, etc. And I don't have a great explanation for why that is, but I'm outside of maybe just the dollars aren't there today. Like my understanding is on the big Morpho V1 vaults, it's extremely competitive with many, curators even foregoing most of their fees for the big pools. So I'm curious, how you see this like if you have an explanation for this, why it might be different in a borrow lend capacity versus say in like a cross intent bridging capacity, or what do you think?
It's a good question. I think what's interesting in lending is that what we are asking curators at the end of the day is to price risk, right? And to look for new risk and give it a good price, right? And this is interestingly not something you can compete to death on, because risk is by essence something that can't be fully automated. What do I mean by this? Is like preventing risk is essentially predicting the future, and there is no such algorithm that predicts the future completely, right? So there is always like an operational part to it, which essentially, as a curator, you will start, uh, being more and more like giving price to more and more exotic things, especially in the context where there is no liquidity fragmentation. In Morpho V2, it's not even a concept. Liquidity is not fragmented because it's promised on multiple places at the same time. And you could promise it to hundreds and hundreds of collaterals. So now you can take the CoinGecko market page and you can look for all of those assets and you can start pricing things, right? And you can start pricing oracles, or like give a price to the risk of oracles, give a price, etc. And so you start with over collateralized lending, but you could imagine even a world where you can start, okay, thinking about what are the bonds in which I can have trust in beyond liquidatable collateral, right? And what if this guy has like an identity and, he is able to prove that he has some reputation? Well, maybe it's not a trustless loan, but you can at least give it a price. And so you can constantly look for new risk. And this dynamic, to my knowledge, is much less automatable than what something you would have for trading, for example. But I'm not an expert in like across solving and all of those things, so I don't know to which extent I can do a parallel with this. But my sense is that there is like fundamental difference in the curator game, where you have this constant push to look for new issuance of loans, which is tough in a pool model because it fragments liquidity. But in the Morpho V2 playbook, you essentially can control the price you give to this risk, and this does not fragment liquidity. And so this is a game changer to explore things that go way beyond current over collateralized lending and could go as far as like under collateralized lending and stuff.
Yeah, super interesting. I think there's a ton of opportunity to like sort of widen out the sort of opportunity set for curators. One thing that I'm thinking about as at BA as kind of our curation business, but also just as like a user and observer, is we've seen like a bit of PvP aspect between curators in Morpho V1. As an example, like when certain pools will have the market conditions change and they become a bit more risky, so everyone would prefer to have their money out of the pool. There's like a rush for the exit, and whoever is able to have infrastructure that executes to get their funds out first, they get their funds out, they have no risk, and then the other person is kind of holding the bag. Um, it feels like maybe there is going to be a similar or maybe even more intense set of PvP aspects between curators and V2. So they'll be competing not only on these risk related factors, like if the collateral gets riskier, they want to sell all of those zero coupon bonds as fast as they can, but also on rates, undercutting each other. um, so like how do you see the sort of PvP aspect of curation evolving? And is that something that will be problematic, or maybe it'll be like really healthy and getting sort of new skill sets in the game?
I think currently it's not super healthy because the dimensions are very like there's not much to play with beyond withdrawing and supplying, right? So you can't even give your opinion on risk that easily. You could, but not that easily. Whereas Morpho V2 is a game of opinions. Like you could say, hey, you know, I'm willing to give this price to like this asset or whatever. And, you know, in some cases, like an oracle goes bad, and we've seen this in Morpho, like um, in Morpho V1 with like, for example, like USD zero oracles in some markets where in the Morpho V2 context, people would have priced this, and I'm sure curators would have priced this very differently. And so now, because the competition and the PvP, quote unquote, is across so many dimensions, at least you have room to do a smarter strategy than just like, I have the fastest execution to get the fuck out whenever something is like, you know, fishy, even though you don't fully understand like what's going on. You prefer just withdrawing, whereas here you could decide to stay but propose a much, you know, stronger, like a much higher rate, or even you could propose, offer exit liquidity to creators that are not fine taking that risk because they haven't analyzed this deeply enough by proposing your own rate to this trade, right? And maybe you do this with your high risk vaults and not with your low risk vault, you know, those kind of dynamics where essentially we facilitate as much as possible coincidence of intents, of intents, because we allow for this expressivity. So I actually think it's going to be super healthy, but it's a game that's hard to predict. Like this is our conviction, but we'll see how it goes. Like I think it's a new experiment. Like, you know, Morpho V2 is unlike anything that has been done in DeFi. We like to take bets, and I think that's a huge one. Is you know, to could have like tremendous upside that goes way beyond like the current state of lending today if it succeeds. And you know, we've done, you know, by the way, every single iteration of Morpho was like a new bet in itself, right? So we're no stranger to this, and we're happy to take it.
Love it. All right, Paul, we got a couple of maybe zooming out of the weeds here, and I wanted to ask some bigger themes of the season type questions for you. And, you know, one thing I'm curious to get your take on here is on this kind of push towards more vertically integrated design. So I'm very curious to get your thoughts on a exchange and borrow lend platform like Fluid, right? Who kind of uses their, I forget the exact word, but kind of, for better lack of a better term, rehypothecate some of that liquidity from their borrow lend vaults to provide liquidity on the exchange. And I think they faced a little bit of criticism around the lever and kind of like the decreased markouts and their strategy there. But I'm just curious, there does seem to be a natural relationship in between at least spot volumes and borrow lend, right? Like that's kind of the most direct driver if you look at those two charts overlaid on top of each other. And so I'm curious if you ever think of vertical integration as a strategy here.
Right. So, you know, this definitely, it's become increasingly clear that DeFi design has an axis between like the more controlled, the more like monolithic versus the more free market driven, right? And so on one end, you have the fluids of the world where everything, you know, or AVV4, where everything is, all the liquidity is fully controlled. And, you know, the big advantage of this is like it's extremely flexible to coordinate the market, right? Because you decide everything and you run this as if you would run like a hedge fund, essentially. And liquidity is shared across everything, you know, even the DEX, even the lending protocol, et cetera, et cetera. So you can get to very interesting like capital efficiencies, right? The downside of this is that because everything is controlled by one entity that enforces and have authority over everything, is in our view scalability, right? It's like you will never be able to discover, like, especially in a world where you have like millions and millions of tokens that are coming on chain, and, you know, billions of credit opportunities for each individuals. I really hardly see like a centralized governance address all those loans and all those trading opportunities in one single pot of liquidity in a way that's centrally managed, right? I even think of it as highly dangerous if it scales, right? Not as it is as it is right now. And so you really have like this split, and, you know, we obviously take the opposite route, which is like the free market route. And I think the biggest like thing you can oppose to the free market route is fragmentation. It's like how do you coordinate players how do you avoid liquidity fragmentation, etc. And this is something we've been thinking a lot about. And this is probably, to me, the key innovation of Morpho V2 is beyond everything, is just like the fact that it's offer based and you can offer your liquidity into multiple markets at the same time. And what that means essentially is that there's no liquidity fragmentation anymore, and you have like the full benefits of a monolithic design, but in a free market approach, right? And so obviously it's not me in charge, so I won't be able to like tweak to the extent that I want, like every single parameter. But I'd rather let the free market do that. So yeah, I don't know if that captures like the essence of the question. Let me know if
No, that does. That does. And sorry, I'm zooming a little bit because I know we're short on time here, but I want to get through these. So I'm curious, Paul, your stance on the demand for stable coins versus other maybe especially like L1 style tokens, right? I think when we saw the early instances of like the skies and the Aves of the world, there was really like kind of on-chain, basically borrow, DAI or USDC against your ETH. And now it seems like the demand is almost entirely driven purely by stable coins. And we've seen Treasury, release that report that said there's going to be $2 trillion worth of stables on chain by 2028. And it seems like that's just really dominated the market here. So, I would love to get any perspectives that you have in terms of this inflow of stable coins and what that means for, like how you see the demand sort of shake out between stables versus other assets.
So when you say versus other assets, that would be like Sol, ETH, BTC. Is that the other assets you're referring to?
Yep. Like let's say the majors.
Well, I guess I would answer this through the lens of like utility. Like, I think because of the nature of ETH, there will be like less demand for lending and borrowing. Just because, like, if you think of ETH as like, okay, like the internet bond, for example, or like the oil, like I feel like it's probably the new narrative. I mean, not the new narrative, but the what the community is starting to really around more and more again. I think it's very natural that it has much less of a financing use case than cash to buy stuff. And even as collateral, like I think it's very capped, like the use case we could have out of this. And for Bitcoin, it's a bigger potential TAM if you think of Bitcoin as like the reserve of value. But for stablecoins, I could only see this growing over time and to be essentially almost just this, because like almost, and if you look at TradFi, like it's very rare that the loan asset is not like an instrument that is used to pay stuff and like is not cash essentially, right? And so where I think we'll see a lot of diversity is like on the trust / collateral side of things. Like what is backing the bond? Is it a crypto asset? Is it more like a risk score, an identity, a legal contract, or like whatever? This I think we'll see more and more innovation. But I think the loan asset, frankly, I hardly see it like moving away from stablecoins. I think we're just going to lean fully into that.
Okay, final closing question, or Monet, let me know if you have anything else. But I'm curious. So this was a big question that frankly I've thought very different about since we did it 2 years ago. But we're very interested in this idea of building an on-chain yield curve. And historically, the way that people thought about that was actually the ETH stake rate, right? So whatever you could earn from staking Ethereum was kind of your risk-free rate, right, so to speak. And then you kind of ladder on, either credit risk or duration or whatever it was, and build a yield curve on chain. And when I look at what you're doing here with fixed rate lending, you can kind of interpolate based on 30, 60, 90, 6 months, you can actually build that yield curve here via Morpho. And so I'm curious just how you think about a yield curve on chain and where it's going to come from. And then if you could end with, do you think that there's eventually going to be convergence in between the yield curve that we see off chain in like the treasury market and crypto?
Right. So yeah, 100%. I think the yield curve will appear as like, with all the data points, like of all the loans on Morpho, I think it will have a similar shape. I really don't see how fundamentally the infrastructure should change this. Like, and, I think my answer to the second part of the question is that, I think all TradFi is going to move on chain. At this point, it's like, it's pretty clear that every single player that is not even in finance has like a roadmap to go on chain, right? And everybody sees this as a future, and I hardly see how. I really think of blockchain as like revolutionizing like purely the infrastructure and the computing mechanics as opposed to the financial mechanics in themselves. And don't get me wrong, like obviously we'll have a ton of like financial innovation because of the openness, etc. But I think it's less fundamental to blockchain technology. And I can't think of an argument why the yield curve, you know, in a few years from now should be different in DeFi than in TradFi, because TradFi will be on chain, right? So maybe it's like it takes slightly different shape because we have more efficiency whatsoever. But yeah, I think it would be the same. This is my gut reaction to this.
Awesome. All right, Paul, this has been really fun. Thanks for going a couple minutes over with us here. But congratulations on everything with
Thank you.
V2, and yeah, we'll have to do it again sometime soon.
Sure.
All right. Cheers, guys.
Cheers.